Hi guys, today we meet for chapter 6. Okay, we are still under part C, which is working capital. But today we are actually going to move into the topic of working capital financing. All right, so I've got a few um, key terms that you would need to learn in this particular topic. Now, just to let you know, in chapter 4 and chapter 5, we did not cover anything relating to cash, all right? We only covered items such as trade receivables, inventory, and also trade payables. So for this video, what we are going to do is, for this chapter, we are going to do chapter 6, which covers or which touches entirely on cash, all right? Everything that we are going to talk about in this topic relates to cash. So let me share my screen and then we will discuss from there. Okay, please use my notes, my chapter 6 notes. Okay, you will see that there is a fixed page where I have annotated a few things on top of it. So we are going to use that, this one, chapter 6. Okay. So we are still under the investment decision, okay, which is we are looking at financing investments in working capital, right? So that means we are talking about the finances that we require to fund our working capital in the company, all right? Now, so as we were talking about cash, okay, for this whole time we did not talk about cash, we did not say anything regarding to cash. So here we are now talking about cash. So what is this chapter all about? So I'm going to tell you what is the main objective. Number one, no space. Okay, number one, we are going to talk about reasons for holding cash. Number two, we are going to talk about cash flow forecast. Number three, we will talk about cash management models. And number four, we will talk about cash surplus. Okay, maybe I don't write it here because actually cash surplus and cash deficit will be part of this, number two and number three. So we also will touch on cash surplus, cash deficit, right? And then number four will be on working capital policy. All right. So now the first objective, okay? Why would a company be required to hold cash as part of their day-to-day operations? Okay? So there are three main reasons why you want to hold cash. The reasons are: number one, for transaction purposes; number two, for precautionary motives; and number three, for speculative motive. Okay, so number one, transaction; number two, precaution; number three, speculative. So what does all these mean? Okay, when you talk about the transaction motive, what it means is that this cash is required by the company to be able to meet their day-to-day obligations. Okay, you want to have sufficient cash to run your day-to-day operations. So maintain sufficient cash run day-to-day operations. Okay. Um, or you can also use the word you require it for a transaction motive to meet regular commitments. The next one, precautionary motive. What does it mean by holding cash for precautionary motive? Okay, it means that you need to ensure your company holds sufficient cash for contingency purposes. All right, so you need to keep or maintain sufficient cash for contingency purposes. Okay, what is the example for contingency purposes? Okay, example, assuming you have a customer who approached you and say, okay, I want to buy 100 units of your inventory, but you do not have that inventory in your warehouse at the moment. So you need to have the cash to go to your supplier and purchase that 100 inventory. So that is keeping cash for contingency purposes. Okay, the finance term that you can use for precautionary motive or for contingency is called buffer. So you need to have buffer cash in your organization. And then finally, the speculative motive. All right, what does it mean by holding cash for speculative motive? That means you want to ensure that you will be able to invest your cash. Okay, why do you call it speculative? Okay, because some companies, when they have surplus cash, what they do is that they invest this cash, okay, as a speculative asset with the hopes that the interest rate will increase and they will make a gain, a higher amount of gain. All right. So here, speculative purposes means for investment purpose. To meet, earn a return. Sorry, not meet. So these are the three reasons why company will normally want to hold cash. But guys, please be aware that your cash surplus that you want to keep for speculation purposes, you cannot keep your or you cannot invest your short-term cash in a long-term investment, because if you do that, your cash will be stuck in the long term, and in case of any emergency in your organization, you won't be able to sell the investment and get back your cash. So normally you will match your short-term cash surplus with short-term investment and long-term cash surplus with long-term investment. Okay, so my question to you next is, so now that I say you require cash for these three purposes, how much is that amount of cash that you require? Or maybe you should ask yourself this question: how do you identify the amount of cash that you need to hold, that you need to keep for a buffer, or that you need to, or you will be able to invest? So that is where you learn the next two methods or the next two elements, which are number one, you will learn the cash flow forecast, okay, and number two, you will learn your cash management models. So now I'm going to ask you guys whether you know how do you how do you draw out a cash flow forecast? Okay, how do you produce a cash flow forecast in the exam? So you must be very careful, because when it comes to cash flow forecast, you must be aware of the timing of cash flow, number one. And number two, you must be aware that whatever information that you use, okay, has to only be cash flow. All right. Now, so when you talk about cash flow forecast, okay, when you talk about cash flow forecast, what do you need to be aware of? Okay, in a cash flow forecast, you need to be aware of how to do it. That means, what is your format, what is your formula? All right, what is your format, what is your formula? And number two, besides knowing your format and your formula, you also need to know how do you record your timing of cash flows. Okay, because your timing of cash flows is extremely important for the purpose of this particular question. Right now, so let me just demonstrate to you how a cash flow forecast. I think it's here. Yes, okay, it's here. So the reason why you do a cash flow forecast is to identify whether your company has a cash surplus or cash deficit. Because once you are able to identify the cash surplus or the cash deficit, you then will be able to see what you can do with the cash surplus or the cash deficit in your company. If you have a cash surplus, yes, you know you can invest it. If you have a cash deficit, you know that you need to find ways to increase that amount so that it is no more a deficit. So normally in an event where you have a deficit cash flow, what you will do is you will sell whatever investments that you have in order for you to be able to get back the money from the investment, and you can keep the cash in your organization. But you also need to remember that if you have cash surplus, you cannot invest 100% of it, because some of the surplus have to be kept for contingency purposes. All right. You also would prefer to invest your cash surplus, because any cash surplus that is sitting in your company account without earning any return is actually redundant. It's not serving any purpose. So you would take that amount of cash and you would invest it so that you would be able to earn return, and it would help in a certain manner to increase the profitability of your company. All right. So you don't want any redundant assets in your organizations. Okay, organization, you want to be able to ensure that those assets in your organization is able to generate a cash inflow for you. All right. So now, how does the cash flow forecast looks like? Okay. So here I have identified cash inflow or cash receipt. So you can also call it cash inflow. And then you have cash payment or cash outflow. Right? So your cash receipts or your cash inflow, it can be sales, can be issue of shares. Why issue of shares? Because when you issue share to the investor will pay you money, so you get the cash inflow to your organization. Your cash payments, you have purchases, taxes, dividends, any form of cash outflow. You cannot include non-cash items. So please write here, exclude all non-cash items. What are examples of non-cash items? Depreciation, amortization. All right. After you have calculated the cash inflow minus your cash outflow, what you will get is your net cash flow. Okay, net cash flow here. Right. I actually like to write it in a different way. Okay, maybe you guys can do this for me, please. What I want you to do is you cancel off this here. Just cancel everything off. This whole line. You put net cash flow here. Net cash flow. So your net cash flow is your cash surplus or cash deficit after you net off the cash inflow and cash outflow. So if it's a negative, it's a cash deficit. If it's a positive, it's a cash surplus. And you need to have cash balance brought forward, interest paid or received, cash balance carry forward. Okay, so this is your format. Please remember your format. Now, for the purpose of this paper, your examiner will not ask you a basic cash flow forecast like this. This is considered basic. It has been tested extensively in the lower level paper, the foundation in financial management. Your examiner is definitely going to make it a little bit more complicated, not something so simple like this. That we can only look at, those type of complicated questions, we only can look at it after we have studied like risk and uncertainty under chapter 10, right? So for now, I'm going to teach you how to do a simple cash flow forecast. And once we have completed the quota for us to be able to do the question, the difficult question, I would definitely do that question together with you. It's something different. Your examiner has only asked it about 2 or 3 times in the past 10 years, all right? But he has recently been asking it a lot more. That means maybe in the past 6 years or past 7 years, he has asked it once. But in the past 3 years, he has already asked it twice. That means on average, 1.5 years once. All right. So please be aware of that particular type of question. I'm just going to name the question here. Flitco is one of it. And the other one is okay, when I remember it, I will let you know. Okay, there are 2 questions. Okay, and another question is a very, very recent question. I think if you guys look at it, you will be able to identify it's a very recent question. Now, before I move on to talking about how we identify what to do with your cash surplus or cash deficit, what I want to do is I want to first go through a question relating to cash flow forecast with you. Okay, the reason why we do this is because I want to show you how a simple cash flow forecast works. All right, so let's look at your past year question compilation. I know this is not a past year question, but I've just included it in there because I don't want to have too many handouts. It's going to become a lot messy. Okay, so if you look at your past year question compilation, okay, just give me a moment. It's supposed to be here. In the past year question compilation here, okay, I have this question. Ben, okay, Ben is a question that was extracted from the BPP book. Okay, it's a a lecture example from your BPP course notes. This is from BPP course notes. Now, let's look at this question and let's see how to do a cash flow forecast type question. Right now, the examiner has asked you to, number one, prepare a monthly cash flow forecast. So you are required to prepare a monthly cash flow forecast. All right, for the first quarter of 20x2, that means January, February, March, right? And he has given you that the opening balance is negative 4550, right? Okay, now guys, you must be very clear when you do this question, because when you do a question relating to cash flow, it is extremely important that you calculate, okay, the cash flows properly by only using cash flows and by properly incorporating the timing of your cash flow, right? So Ben is a wholesaler of motorcycle helmets. It is January 20x2. So credit sales in the last quarter of 20x1. So you have October, November, December. This is helmets, means these are number of units. His credit sales in the first quarter will be as follows: January, February, March. So these are all your credit sales, okay? Customers are given 60 days credit period and the average selling price is $10. Guys, I want you to be careful because customer is given 60-day credit period, okay? If customer is given 60-day credit period, that means if the customer purchase it in October, when will he make the payment? October, November, and December. So for October, the payment is made in December. That means you will receive your cash only in December. Payment received. December. Here for November, it will be in January. Subsequently, February, March, April, and May. So why I say December, January, February until May? Because if your sale is made in October, he will take 2 months to pay. 2 months from October is December. 2 months from November, January. 2 months from December, February, so on, right? But what is important for me is the cash flow that I will receive in the first quarter, because that is my concern. So in my first quarter will be January, February, and March. That means I will receive the sales from November, December, and January. That is what I will record in my working. Okay. Now, if these are the number of units, when you want to calculate the total sales revenue, what you do is you multiply by 10. So multiply 10, multiply 10, multiply 10. So these are all the credit sales item. Now, his biggest customer, Mixter, is given a 2% discount for paying cash. So please be careful. You now have credit sales and also cash sales, right? So he will pay cash when the sale is made. Mixter is planning to buy 150 helmets in January, 250 helmets in March. That means he buy and he pay immediately. So for the month of January and March, you will have a cash sales of 150 helmets and 250 helmets respectively. You have to multiply by the selling price of $10. The sales to Mixter are in addition to those credit sales above. That means these are extra or additional sales on top of the credit sales that you are already making. All right. So now let's do our format. I don't want to read the whole question altogether, then it's like not going to be useful for us. So I'm going to share my screen. I'm going to draw out the format for you, and we will fill up the format as and when we have completed reading certain areas. All right. So the next one, draw chapter 6. Capital finance. All right. So cash flow, forecast. You have month, you have January, February, and March. Cash inflow, at the moment you have sales, or maybe I would identify it as credit sales. November, December, January. And then I have cash sales from Mixter. Right? Okay, I don't know whether there are any other cash inflow, but I'm going to stop here and I'm going to complete this area first. Okay, so my November sales that I would receive the money in January is 20,000. So here is 2,000 multiplied by 10. So I'll receive the money in January, 20,000. My December sales is 2,500 multiplied by 10. So this would be 25,000. And your January sales of 3,000 helmets at $10 each would be equivalent to 30,000, right? Your cash sales, on the other hand, okay, from Mixter, okay, January and March. So in January, I think it's 150. Can we double check? Yes, in January it's 150. So 150 multiplied by 10, but there is a 2% discount. So multiply 98%. In March, 250 multiplied by 10. Again, 2% discount multiplied by 98%. 150 multiplied 10, 0.98. 1470. 250 multiply 10 multiply 0.98. 2450. Okay, now I'm going to leave a few lines before I move on, but let's continue reading the question first. So now sales is done, right? The next one, purchase on an average of 30 days credit. That means you buy now, you pay 1 month later. So if you buy in April, you pay in May, example. All right. So the purchases of $4 per helmet. So you sell it for $10, but you buy it at $4 per helmet. Ben plans to buy in the helmets a month in advance of selling them. So guys, please be a bit careful here. Let's say you want to use it in January. What you will do is you will buy in December. So this is the point where you buy. The payment will be made 30 days after purchase. That means the payment is made in January. The meaning, what it means is that the purchase for January was made in December and the payment is made in January. All right. Now, Ben plans to buy a helmet, okay, 1 month in advance. Okay, total overheads are 2,000 per month, which includes $400 of depreciation and wages of 1,000. Now, guys, out of 2,000, 400 is wages. $400 is depreciation. $1,000 is wages. Which of these two are relevant or non-relevant? Okay. So the one that is not relevant is depreciation because it's a non-cash item. Wages is a cash flow, so it is relevant. And all other overheads, since he has not mentioned what it is, you're just going to assume that it is relevant because it's a cash flow. Okay. Now, all other overheads are paid after a credit period of 30 days. Okay. Now, let's go ahead and do this part now. These are all cash outflows. So I'm going to leave a few lines. Then I'm going to go to cash outflow. You have purchase. Okay. Your purchase for January is made in December but paid in January. So here, January, February, March. So it will be 3,000 units multiplied by 4. Okay. Guys, do not forget your cash sales. So 3,150. Why I say 3,150? 3,000 is the credit sales. 150 is the cash sales. So 3,150 multiplied by 4. 12,600. Okay, so you can see my figure here in my calculator. When you can see, okay. In February, it is 5,000 multiplied by 4. So that's 20,000. Negative. Here, in March, it would be 4,500 plus 250 multiplied by 4. So 4,750 multiplied by 4 is 19,000. The next one, overheads, is 2,000 minus 400. 1,600. 1,600. All right. Okay, now let's continue reading the question. Ben plans to inject a further 5,000 of his own money into the business. So that is your cash inflow. And he plans to invest it in March. So your cash inflow in March would be $5,000. So here you just need to add capital. In March, 5,000. Your cash outflow, right? The non-current assets, he would also buy it in March. It is 24,000. So that would be a cash outflow in March, 24,000, right? So non-current asset purchase, $24,000. All right. Now, what I want you to do is I want you to find for me the net cash flow. That means total inflow minus total outflow. Please find for me the cash net cash flow. All right. So I'm going to do it together with you as well. All right. So 221470 minus 12600 minus 1600. Here is 7270. 25,000 minus 21,600. This is 3400. In March, 30,000 plus 2450 plus 5,000 minus 19,000 minus 1,600 minus 24,000. Here the net cash flow is 7150. Now, no interest payment, so I don't need to do anything about interest. So you just put opening balance, closing balance. Now, in year one, it was negative 4550. Where you get it, it's from the question requirement. 7270 minus 4550 is 2720. Now, closing balance of year one will be opening balance of year two. So 2720. So this is a positive figure. Plus 3400. 6120. Now, again, closing balance year two, opening balance of year one, 6120. So minus 7150, your cash flow, your closing balance is 1030. So from this question, you can see that this company has a cash surplus for year one and year two. Sorry, it's actually not year one and year two. The first month and the second month, January and February. And for the third month, March, it has a cash deficit of 1030. So from here, you can see that by producing a cash flow forecast, you are able to identify what is the need of cash flow in your company. Whether you have enough cash available for performing, whether you have available cash to support your organization. If you don't have enough cash, you may need to borrow. So you can use a short-term borrowing, you can use a long-term borrowing. That depends on how your company wants to manage the cash flows. All right. So once you have completed this, then it would be much easier for me to explain to you the cash surplus and cash deficit. All right. So the next video, I'm going to explain to you about cash surplus, cash deficit, and I'm going to move into the next part, which is your cash management